Unlocking stock market secrets. Let's decode those key stats. Alright guys, what is up? It's PK for life here. And today we're diving deep into something that, honestly, can seem super intimidating when you're first starting out in the stock market. All those numbers and stats you see on a stock page. Have you ever wondered what all the numbers on companies' stock pages mean? You pull up a stock, maybe on Robinhood, Webull, or whatever platform you're using, and bam! You're hit with a wall of data. It's a lot, I get it. But here's the good news. Understanding these numbers is absolutely key to making smarter investment decisions. Nothing can perfectly predict the price of a stock, let's be real. If it could, we'd all be millionaires by next Tuesday. But the numbers we'll learn about can help you better understand the company itself and how its stock behaves. Think of it like getting the inside scoop, a better feel for what you're actually putting your hard-earned money into. On each stock page you can find the graph, the squiggly line showing the price action. Then there's usually some risk ratings, a bit about the company history, and then, the section we're focusing on today, the key stats section. This is where the magic happens, or at least where a lot of crucial information is packed. It's easy to just glance over them, or worse, ignore them completely because they seem too complex. But trust me, once you get a handle on what they represent, it's like a light bulb goes off. Suddenly, you're not just guessing, you're analyzing. In this journey, we'll learn about 8 numbers: market cap, 52-week high-low, volume and volatility, dividend yield, earnings share, PE ratio, risk ratings, and even analyst ratings. That's a solid lineup, and each one tells a unique part of the company's story. So if any of those numbers sound new, or maybe you've heard of them but aren't quite sure what they mean or how to use them, then stick around. Seriously, grab a coffee, get comfortable, because we're going to break these down one by one in plain English, no crazy jargon. My goal here is to help you feel more confident, more informed, and ultimately, more successful in your investing journey. Let's level up your investing knowledge together. And hey, if you appreciate this kind of breakdown, do me a solid and smash that like button for the YouTube algorithm. It really helps the channel out. Alright, let's get into it. Market cap sizing up companies like a pro. Alright, first up on our list, and it's a big one, literally, market cap or market capitalization. You'll see this on pretty much every single stock quote. So, what exactly is it? In simple terms, market cap is the total dollar market value of a company's outstanding shares of stock. Think of it as the size of the company in terms of its stock market valuation. If you wanted to buy every single share of that company at its current market price, the market cap is theoretically what it would cost you, though in reality, trying to buy all shares would drive the price up, but that's a topic for another day. For now, just know it's the overall market value. So, how is this magical number calculated? It's actually pretty straightforward, which is nice. You take the current market price of a single share of the company's stock, and you multiply that by the total number of outstanding shares. So, if Company X has 10 million shares outstanding, and each share is trading at $50, then its market cap would be $500 million. Simple math, right? But this simple number tells you a whole lot about the company's scale and often, its perceived stability or growth potential by the market. It's one of the first metrics investors look at to get a quick snapshot. Now, not all companies are created equal in size, and market cap helps us categorize them. Generally, you'll hear about a few main categories. First, you have the mega cap stocks. These are the giants, the household names, typically with market caps over $200 billion. Think Apple, Microsoft, Amazon, the behemoths of the stock market. They're usually seen as more stable, established companies, though even they can have their ups and downs, of course. They're so large that their movements can sometimes influence the entire market. Then we step down a bit to large cap stocks. These companies usually have market caps between $10 billion and $200 billion. Still very big, well-established companies, often leaders in their industries. Many of your blue chip stocks will fall into this category. They generally offer a good balance of growth and stability, though again, generally is the key word here. Investing always carries risk, no matter the cap size. These are the companies that are significant players, often with a global presence and a long track record. Next up are the mid-cap stocks, typically ranging from $2 billion to $10 billion in market capitalization. These companies are often in a growth phase. They might be expanding, innovating, and potentially offer higher growth opportunities than large caps, but this can also come with a bit more volatility and risk. They're sort of in that sweet spot where they're established enough to have a solid business model but still have significant room to grow. For investors looking for that next big thing before it becomes a household name, mid-caps can be an interesting area to research. Then we have small-cap stocks, which usually fall between $300 million and $2 billion. And below that, you might even hear about micro-cap or nano-cap. But small caps are where many individual investors start looking for those hidden gems. These are smaller companies, often younger, and they can be much more volatile. They have the potential for explosive growth, but also a higher risk of failure. Investing in small caps requires a lot of due diligence because their fortunes can change quickly, based on new products, market shifts, or even a single big contract. So, why does market cap even matter to you as an investor? Well, it helps you understand the risk and growth profile of a stock. Larger companies are often perceived as safer bets, less volatile, and might pay dividends. Smaller companies, on the other hand, might offer higher growth potential but come with increased risk. It also helps with diversification. You might not want your entire portfolio in just small-cap stocks or just mega-cap stocks. Understanding market cap allows you to build a more balanced portfolio that aligns with your risk tolerance and investment goals. It's a foundational piece of the puzzle. Riding the waves, understanding 52-week highs and lows. Alright, let's move on to our next key stat, the 52-week high and low. This one is pretty self-explanatory on the surface, but there's some good nuance to understand here. When you look at a stock quote, you'll almost always see these two numbers listed. The 52-week high is the highest price that a stock has traded at during the previous 52 weeks, which is essentially 1 year. Conversely, the 52-week low is the lowest price the stock has hit during that same 1-year period. It's like looking at the peak and valley of the stock's price journey over the past year. So, why do we care about these numbers? Well, they can give you a quick sense of the stock's recent price range and its current position within that range. If a stock is trading near its 52-week high, it might suggest that the stock has strong positive momentum, or perhaps it's becoming overbought. On the flip side, if a stock is lingering near its 52-week low, it could indicate that the company is facing challenges, or, for the bargain hunters out there, it might potentially be undervalued. I say might, and potentially because these numbers alone don't tell the whole story, not by a long shot. It's really important to understand that just because a stock is near its 52-week low, doesn't automatically make it a good buy. There could be very valid reasons why the stock price has fallen. Maybe the company has declining sales, or it's in a troubled industry, or there's some bad news that just came out. A falling knife, as they say, can cut you if you try to catch it too soon. You need to dig deeper and understand it's at that low point before even considering it as an investment. Is it a temporary setback for an otherwise solid company, or is it a sign of deeper, more systemic problems? Similarly, a stock hitting new 52-week highs isn't automatically a signal to sell or to avoid buying, thinking it's too expensive. Sometimes strong companies just keep getting stronger, and their stocks reflect that continued growth and success. The old saying, "the trend is your friend," can sometimes apply here, where stocks making new highs continue to make new highs. However, it could also mean the stock is getting a bit frothy, and a pullback might be due. Again, context is absolutely king. You need to look at the overall market conditions, the company's fundamentals, and news surrounding the stock. So how can you actually use this information in a practical way? Many traders and investors use the 52-week range as a reference point. For example, some momentum traders might look for stocks breaking out to new 52-week highs as a sign of strength and a potential entry point, assuming the volume supports the breakout. Value investors, on the other hand, might screen for stocks trading near their 52-week lows, and then start their research process from there to see if they can find a company that the market has unfairly punished. It's also a good psychological indicator. Seeing a stock you own continually hit new 52-week lows can be pretty demoralizing, right? And seeing one hit new highs can make you feel like a genius. But emotions can be dangerous in investing. The 52-week high-low provides a factual data point about the stock's recent performance spectrum. It helps you frame the current price. Is it at the top of its recent game, the bottom, or somewhere in between? This can be a starting point for further questions and deeper analysis. Ultimately, the 52-week high and low are like signposts on the stock's price highway. They tell you where it's recently been, but not necessarily where it's going. Don't use them in isolation. Combine them with other metrics like the market cap we just talked about, and the upcoming stats we're going to cover. They are pieces of a much larger puzzle. but understanding this range gives you a better perspective on the stock's volatility and recent market sentiment towards it. It's a simple tool, but a useful one to have in your investor toolkit. The stock market's pulse decoding volume and volatility. Next up, let's talk about two V's that are super important in the stock market: volume and volatility. These two often go hand in hand, but they measure different things, and understanding both can give you a much clearer picture of a stock's activity and its potential risk. Let's start with volume. When you see volume listed for a stock, it refers to the total number of shares that were traded during a specific period, usually a single trading day. So, if a stock's volume is 1 million, it means 1 million shares of that company changed hands that day. Why is volume such a big deal? Well, high volume can indicate a high level of interest in a stock, whether that interest is buying or selling. If a stock price makes a big move, either up or down, on high volume, it generally gives more conviction to that move. It suggests that a lot of market participants are agreeing on the new price level. Conversely, if a stock price changes significantly on very low volume, that move might be less reliable or sustainable, as it was driven by fewer trades and less overall market conviction. Think of it like this: if a crowd is cheering loudly, it means something significant is happening. Volume can also tell you about a stock's liquidity. Liquidity refers to how easily you can buy or sell a stock without causing a significant change in its price. Stocks with consistently high volume are generally more liquid. This means if you want to buy 100 shares or sell 100 shares, there are likely plenty of buyers and sellers available, and your order will get filled quickly close to the current market price. For very low volume stocks, it might be harder to get in or out at the price you want, and your own trade could even move the price a bit, which is known as slippage. Now let's switch gears to volatility. Volatility measures how much a stock's price fluctuates over time. A highly volatile stock will see its price swing up and down dramatically, while a low volatility stock will have a more stable price, trading in a tighter range. Volatility is often expressed as a percentage or using metrics like beta, which compares a stock's volatility to the overall market. A beta greater than 1 means the stock is more volatile than the market, while a beta less than 1 means it's less volatile. So, how does volatility relate to risk? Generally, higher volatility is associated with higher risk. If a stock can swing 10% up one day and 10% down the next, that's a wild ride, and there's a greater chance of losing a significant amount of money quickly, although there's also the potential for quick gains. Lower volatility stocks are often seen as safer because their prices don't jump around as much, making them more suitable for conservative investors or those with a lower risk tolerance. However, lower volatility might also mean lower growth potential in some cases. It's important to match a stock's volatility with your own investment goals and risk tolerance. If you're a long-term investor looking for steady growth and you can't stomach big price swings, then highly volatile stocks might keep you up at night. But if you're a short-term trader, volatility might be exactly what you're looking for, as it creates opportunities to profit from those price movements. There's no good or bad level of volatility, it just depends on what you're trying to achieve and how much uncertainty you're comfortable with. So, when you see volume and volatility figures, think of them as indicators of the stock's current energy and choppiness. High volume can confirm trends, and high volatility signals a potentially bumpier ride. For instance, if a stock suddenly has a huge spike in volume accompanied by a sharp price increase, that's a strong signal that something significant is happening, maybe good news, an earnings beat, or a buyout rumor. Understanding these two metrics helps you gauge market interest, assess risk, and make more informed decisions about when and how to trade a particular stock. They are dynamic indicators of the market's current mood towards a security. Alright, let's talk about something that a lot of investors, especially those focused on long-term growth and income, really love: dividend yield. If you've ever heard of stocks paying you to own them, dividends are what people are talking about. So, what exactly is a dividend? A dividend is a distribution of a portion of a company's earnings, decided by its board of directors, to a class of its shareholders. Companies pay dividends as a way to share their profits with their owners, the shareholders. Not all companies pay dividends though. Younger, high-growth companies often reinvest all their profits back into the business to fuel further expansion. Now, the dividend yield is a financial ratio that tells you how much a company pays out in dividends each year relative to its stock price. It's expressed as a percentage. The calculation is pretty simple. You take the annual dividend per share and divide it by the current market price per share. For example, if a company pays an annual dividend of $2 per share, and its stock is currently trading at $50 per share, the dividend yield would be $2 divided by $50, which equals 0.04 or 4%. So, for every $100 you invest in that stock, you'd expect to receive $4 in dividends per year, assuming the dividend stays the same. Why is dividend yield important, especially for long-term investors? Well, for one, it provides a stream of income. This can be particularly attractive for retirees or anyone looking to supplement their regular income. Instead of just relying on the stock price going up, capital appreciation, you're also getting these regular cash payments. It's like getting rent from a property you own. But in this case, the property is your shares in the company. This income can then be reinvested to buy more shares, leading to a compounding effect over time, or it can be used for living expenses. A consistent and growing dividend can also be a sign of a company's financial health and stability. Companies that are able to pay dividends regularly, and even increase them over time, are often well-established, profitable businesses with strong cash flow. Think of companies in mature industries like utilities, consumer staples, or some large financial institutions. These are often referred to as dividend aristocrats or dividend kings if they have a long history of increasing their dividends year after year. This track record can provide a sense of reliability. However, it's crucial not to chase a high dividend yield blindly. A very high yield can sometimes be a red flag or a yield trap. Why? Because the yield is a function of both the dividend payment and the stock price. If a company's stock price has fallen significantly, perhaps due to underlying problems with the business, its dividend yield will go up, even if the dividend payment itself hasn't changed. In such cases, that high yield might not be sustainable if the company is in trouble and might have to cut its dividend in the future. So, a super high yield warrants extra investigation. You also need to consider the company's dividend payout ratio, which is the percentage of its earnings that it pays out as dividends. A very high payout ratio, like over 80 to 90%, might mean the company isn't retaining enough earnings to reinvest in its own growth or to weather tough economic times, potentially putting future dividend payments at risk. A lower, more sustainable payout ratio is often preferred, as it suggests the company can comfortably afford its dividend and still have money left over for growth initiatives. So, when you look at dividend yield, consider it as one part of your overall investment strategy. Is income generation important to you? Are you looking for potentially more stable, mature companies? If so, dividend-paying stocks and their yields will be a key metric. But always look at the bigger picture: the company's financial health, its history of dividend payments, the sustainability of the dividend, and how it fits into your diversified portfolio. A good solid dividend yield from a strong company can be a fantastic way to build wealth over the long term. Alright, let's dive into another critical metric that gives you insight into a company's profitability: earnings per share or EPS. You'll see this figure everywhere, and it's a really fundamental concept in stock analysis. So, what is it? EPS represents the portion of a company's profit that is allocated to each outstanding share of common stock. Essentially, it's a measure of how much money a company earns for each share of its stock. A higher EPS generally indicates greater profitability and a stronger financial performance. The calculation for basic EPS is fairly straightforward. You take the company's net income, its profit after all expenses and taxes, subtract any dividends paid to preferred shareholders, because preferred shareholders get paid before common shareholders, and then divide that result by the average number of common shares outstanding during that period. So, the formula looks like net income, preferred dividends, average outstanding common shares. This gives you a dollar value like $2.50 EPS, meaning the company earned $2.50 for each share. Why is EPS so important? Well, it's one of the most widely used metrics for investors to assess a company's profitability on a per-share basis. It allows for a more standardized way to compare the earnings power of different companies, even if they are of vastly different sizes or in different industries, though comparisons are most meaningful within the same industry. If Company A has an EPS of $5 and Company B has an EPS of $2, all else being equal, Company A is generating more profit for its shareholders on a per-share basis. Investors also pay very close attention to EPS trends over time. Is the company's EPS growing, stable, or declining? A consistent growth in EPS year over year is often seen as a very positive sign, suggesting the company is becoming more profitable and efficient. This can drive the stock price up, as investors become more optimistic about the company's future prospects. Conversely, a declining EPS can be a warning sign that the company might be facing challenges, losing market share, or becoming less efficient. Quarterly earnings reports, where companies announce their latest EPS figures, are therefore highly anticipated events in the financial world. There are actually a couple of types of EPS you might encounter. There's trailing EPS, which is based on the company's earnings over the past 4 quarters, the past year. Then there's forward EPS, which is an estimate of the company's earnings for the next 4 quarters, usually based on analysts' projections. Both are useful. Trailing EPS tells you what the company done, while forward EPS gives you an idea of what the market is to do. Of course, forward EPS is just an estimate and can be wrong, but it reflects current market sentiment and expectations. When you're looking at EPS, it's also good to understand what can influence it. Obviously, higher net income will boost EPS, but companies can also influence their EPS through share buybacks. When a company buys back its own shares, it reduces the number of outstanding shares. If net income stays the same or grows and the number of shares decreases, EPS will go up. This isn't necessarily a bad thing. Share buybacks can be a tax-efficient way to return value to shareholders, but it's good to be aware of EPS is growing. Is it purely from operational profit growth, or is it also getting a boost from financial engineering like buybacks? Ultimately, earnings per share is a cornerstone of fundamental analysis. It provides a clear, quantifiable measure of a company's profitability from the perspective of an ordinary shareholder. When you see a company consistently beating EPS estimates and showing strong EPS growth, it often leads to positive investor sentiment and can be a catalyst for stock price appreciation. But like all metrics, don't look at it in a vacuum. Consider it alongside revenue growth, profit margins, debt levels, and the overall economic environment to get a complete picture of the company's financial health and future prospects. Alright, now that we've covered earnings per share, EPS, let's talk about a ratio that directly uses it, the price-to-earnings ratio, or PE ratio. This is probably one of the most famous valuation metrics out there, and you'll hear it talked about constantly. So, what does it tell us? The PE ratio essentially indicates how much investors are willing to pay for each dollar of a company's earnings. It gives you a sense of whether a stock is relatively expensive or cheap compared to its earnings. The calculation for the PE ratio is simple. You take the current market price per share of the stock and divide it by its earnings per share, EPS. So, PE equals stock price divided by EPS. For example, if a stock is trading at $100 per share and its EPS for the last 12 months, trailing EPS is $5, then its PE ratio would be 100 divided by 5, which equals 20. This means investors are willing to pay $20 for every $1 of that company's current earnings. It's a way to standardize valuation across different stock prices. So what does a high or low PE ratio signify? A high PE ratio, say above 25 or 30, though this varies by industry and market conditions, often suggests that investors expect higher earnings growth in the future. They are willing to pay a premium for the stock today because they believe the company's profits will increase significantly, which would eventually justify that higher price. Growth stocks, especially in fast-moving sectors like technology, often have high PE ratios. It reflects optimism and high expectations. On the other hand, a low PE ratio, perhaps below 10 or 15, might indicate that a stock is undervalued, meaning it's cheap relative to its earnings. Or it could mean that investors have lower expectations for the company's future growth. Value stocks, which are companies that investors believe are trading for less than their intrinsic worth, often have lower PE ratios. It might be a mature company with stable but slow-growing earnings, or a company that has fallen out of favor with the market for some reason. You might also encounter a negative PE ratio. What does that mean? Well, since the stock price can't be negative, a negative PE ratio means the company has negative earnings per share. In other words, it's losing money. When a company isn't profitable, the PE ratio isn't really a meaningful metric for valuation in the traditional sense because there are no earnings to compare the price to. For such companies, investors often look at other metrics like price-to-sales ratio or focus on future growth potential and paths to profitability. It's super important to remember that the PE ratio should not be used in isolation. What's considered a good or bad PE can vary dramatically between industries. For example, a tech company might have a PE of 40 and still be considered reasonably valued given its growth prospects, while a utility company with a PE of 40 might be seen as extremely overvalued because utilities typically have slower, more stable growth. So, always compare a company's PE ratio to its historical PE range and to the PE ratios of its direct competitors in the same industry. Furthermore, the PE ratio is just one piece of the valuation puzzle. A low PE doesn't automatically mean a stock is a bargain. It could be a value trap, a company that's cheap for a good reason, like declining fundamentals. And a high PE doesn't automatically mean a stock is overvalued. It could be a fantastic company with massive growth ahead. You need to consider the E part, the earnings. Are earnings growing? Are they sustainable? What are the future prospects? The PE ratio is a great starting point for asking these deeper questions. It helps you understand market sentiment and relative valuation. Alright guys, let's talk about something that's crucial for every single investor, no matter your experience level, and that's understanding risk ratings. When you're looking at a stock on your brokerage platform or a financial website, you'll often see some kind of risk rating or risk score assigned to it. This is designed to give you a quick idea of the level of risk associated with investing in that particular stock, often tied very closely to its volatility, which we discussed earlier. It's like a quick safety check before you decide to dive in. These risk ratings are usually provided by the brokerage firm itself, or by third-party financial data providers. They might be presented as categories like low risk, medium risk, high risk, or sometimes on a numerical scale, say from 1 to 5, where 1 is lowest risk and 5 is highest. The methodology behind these ratings can vary, but they typically take into account factors like the stock's historical price volatility, how much its price has fluctuated, the company's financial stability, its size, market cap, the industry it's in, and sometimes even its debt levels. So, how are these risk ratings related to a stock's volatility? Very closely, in fact. As we learned, volatility measures the degree of variation in a trading price series over time. Stocks that have historically shown large and frequent price swings will generally receive a higher risk rating. This makes sense, right? If a stock can drop 20% in a week, that's inherently riskier in terms of potential capital loss than a stock that typically only moves a percent or two. So a high risk rating often implies high volatility and vice versa. The most important thing about these risk ratings is understanding how they relate to your own personal risk tolerance. Everyone's financial situation, investment goals, and comfort level with risk are different. If you're young and have a long time horizon before you need the money, you might be comfortable taking on higher risk investments with the potential for higher rewards. If you're nearing retirement or are generally more conservative with your money, you'll likely want to stick with lower risk investments, even if the potential returns are more modest. There's no right or wrong here. It's about what's right for you. Comparing your personal risk tolerance with a stock's assessed risk level is a critical step before making any investment. If a stock is rated high risk, and you know you're someone who gets stressed out by large portfolio swings, then that stock, no matter how enticing its potential upside seems, might not be a good fit for you. Investing in something that keeps you up at night is generally not a sustainable strategy. You want to be able to sleep soundly knowing your investments align with your financial personality. It's also worth noting that risk ratings, while helpful, are not foolproof predictors of future performance or future risk. They are typically based on historical data and current analysis. Conditions can change. A company that was once considered low risk could face unexpected challenges that increase its risk profile. And a high-risk company could mature and become more stable over time. So, while these ratings are a good starting point, they shouldn't be the only factor in your decision-making process. Always dig a little deeper. Think of risk ratings as one tool in your due diligence toolbox. They provide a quick snapshot, a general guideline. Use them to filter out stocks that are clearly outside your comfort zone. For example, if you've decided you only want to invest in low to medium risk assets, you can use these ratings to quickly screen out the high risk ones. But then, for the stocks that do fit your general risk profile, you still need to do your homework on the company's fundamentals, its growth prospects, and its valuation, using the other metrics we've been discussing. It's about building a complete picture. Alright, our final key stat for today, analyst ratings. You've probably seen these buy, sell, hold recommendations that pop up next to stock tickers. These ratings come from financial analysts, typically working for investment banks, brokerage firms, or independent research companies. Their job is to research companies in specific industries, analyze their financial health, growth prospects, and competitive landscape, and then issue an opinion on whether they think the stock is a good investment at its current price. So, what do these common ratings mean? A buy rating, or sometimes strong buy or outperform, suggests the analyst believes the stock is likely to perform better than the overall market or its peers, and that its price will go up. A hold rating, or neutral or market perform, usually means the analyst expects the stock to perform roughly in line with the market or its sector, and that there's no strong reason to buy more or to sell existing shares. A sell rating, or underperform or strong sell, indicates the analyst believes the stock is likely to do worse than the market, and its price may go down, suggesting investors should consider selling their shares. Analysts also often provide a price target, which is their estimate of where they think the stock price will be in, say, the next 12 to 18 months. If the current stock price is well below an analyst's price target, that might support a buy rating. If it's above the price target, that might lean towards a sell. These ratings and price targets are usually accompanied by a research report that explains the analyst's reasoning, which can actually be quite detailed and insightful, covering industry trends, company strategy, and financial forecasts. How can these analyst ratings provide insights into a stock's potential performance? Well, these analysts often have deep expertise in the sectors they cover. They might have access to company management, attend industry conferences, and spend a lot of time building complex financial models. So, their opinions can offer a valuable perspective, especially on companies or industries you might not be as familiar with. Reading their reports can help you understand the bull case, why the stock might go up, and the bear case, why it might go down, for a particular stock. However, and this is a big however, it's crucial to take analyst ratings with a grain of salt, or maybe even a whole shaker of salt. Analysts are human, and they can be wrong. Their predictions are not guarantees. Sometimes analysts can be overly optimistic, especially if their firm has an investment banking relationship with the company they're covering, which could create a potential conflict of interest, though regulations aim to mitigate this. Also, sell ratings are historically much less common than buy or hold ratings, which some critics point to as a sign of inherent bias. It's also important to look at the consensus among analysts rather than just one single opinion. If 10 analysts cover a stock and 9 rate it a buy while 1 rates it a sell, that tells you something different than if the ratings are evenly split. Many financial platforms will show you a summary of analyst ratings, like the number of buy, hold, and sell recommendations. Also, look at the track record of the specific analyst or firm, if that information is available. Some analysts are consistently more accurate than others. Ultimately, analyst ratings should be just one input into your own research process, not the sole basis for an investment decision. Use them as a starting point for ideas or to understand different viewpoints. But always do your own research. Read the company's financial reports, understand its business model, look at its competitors, and consider the overall economic environment. Form your own opinion. Analyst ratings can be a helpful guide, but you are the ultimate decision maker for your portfolio. Don't blindly follow the herd, even if the herd is made up of experts. Alright guys, that was a deep dive, but hopefully it was super helpful. We've covered a ton of ground today, from market cap all the way to analyst ratings. Now you have a better understanding of the key numbers on a stock page, and how they can help you make informed investment decisions. Seriously, knowing what these metrics mean, like PE ratio, EPS, dividend yield, and volatility, can transform you from a passive observer into an active analytical investor. It's about moving beyond just looking at the price chart and really understanding the why behind a stock's behavior and a company's valuation. This knowledge is your power in the market. But here's the most important takeaway. Remember, always do your own research and consider multiple factors before making any investment. No single number tells the whole story. These stats are tools, and like any tool, they are most effective when used together, in context, and combined with your own critical thinking. The market is complex, and continuous learning is key. Don't just take my word for it, or anyone else's for that matter. Use this information as a springboard to dig deeper, ask more questions, and develop your own investment philosophy. Your financial future is too important to leave to chance or to someone else's hot tip. And hey, if you want to continue this journey with a community of like-minded individuals, I'd love to invite you to join our Discord community, Blood Diamond, where like-minded traders can chat and hit trades together. It's a great place to share ideas, ask questions, and learn from each other. The link is in the description below. Thank you so much for sticking with me through this one. If you found this valuable, please smash that like button. subscribe if you haven't already, and hit that notification bell so you don't miss out on future videos. Stay tuned for more lessons and let's continue to level up your investing knowledge together. Catch you in the next one.